Hello friends. Today I'm going to talk about what a monthly payment could look like for a mortgage loan that maybe you're interested in. And to be able to do that, I created this Excel workbook, has some data that you would need to be able to figure out this calculation. So you see on the screen basic information like what is the rate. We're going to assume for this example that our loan has an interest rate of 4.5%. The next piece of data that's required is periods per year. We're talking about a mortgage. You pay this every month, so 12 months in a year. Period. We're first going to start with what does my initial monthly payment look like as far as a breakdown between principal and interest. So I'm going to leave this as a 1, but I'll come back to it in a moment. Number of periods, in this example, 360. 360 represents a 30-year mortgage. It's 30 times 12. If you have a 15-year mortgage, cut this in half. If you have a 20 or 25, scale accordingly, but it's number of months times the number of years. Principal value, for this example, I'm going to assume that the loan is for $350,000. Final value, 0. This is eventually going to be paid off. And then the type field is 0 or a 1. Mortgages tend to be due on the 1st of every month, so I am utilizing a 0. Now we get into the Excel function. PPMT is for principal amount of a payment. And if I click on the cell, you will see that it is grabbing all the data that we just entered above. So we're looking at the rate and dividing by the period per year, and then all the other data in that order separated by commas. I will point out I do include a little negative here, otherwise it gives you a negative number, and I just like the look of a positive number, but it's personal preference. That is your principal amount, interest amount. If you look in the field here, all you do is change that first P to an I. You're grabbing all the same data in the same order, and you get the interest piece. So you add these two together, and we have our principal and interest for a particular month. I'm going to go back to this yellow field. This would be what our first month payment would look like, but let's say we're pretty far along. We're month 200. You saw that the principal and interest amount changed. At this point in the mortgage, we are paying more principal than interest. But if you remember back in the beginning, in month 1, most of our payment is going towards interest, which is typical, but it's just fun to see what month does your loan start flipping and more of your payment goes to principal instead of interest. If you're curious, you can play around with the formulas. If you decide to escrow your insurance and taxes, it will be more than just your principal and interest. There'll be a few other numbers that you need to add on. This includes insurance. Now you may have a quote from your insurance carrier of a dollar value per month, $300, $200. You would just tack that on. In this case, if I don't have a quote, I am just using a typical 0.78% of a home value. This is not the loan value, but a home value, because you're insuring the property and perhaps its contents as well. Depending on your policy, you will have an insurance dollar value to add. Taxes, unavoidable. We have taxes that are associated with our home value. So again, not the loan amount, the home value. This example, I'm using 2.5%. So the math is 2.5% of 380, and we're dividing by 12 because we want a monthly payment. And the other piece is a homeowners association due, if it's applicable to that property. Take the yearly amount, divide by 12, and it's like a placeholder. And lenders will use that to ensure that a borrower can afford the HOA payment, even though this may be billed quarterly or yearly separate. But just to make sure you qualify, it will be added. Therefore, your lender will quote you a monthly payment that's principal and interest, and if you're escrowing, insurance, taxes, and then the HOA piece, and then your total value, approximately what you could expect your bank to be charging you once a month. Now, if you, as you're chugging along, your interest rates change from year to year, which a lot of ours do, or maybe your insurance coverage changes, obviously your monthly payment will change, but your principal interest amount will stay the same. It's just the split between the principal interest that will evolve over time. So if you have any questions on this calculation, or you're trying to recreate it yourself, maybe run into a question of, how is this working out, or your what if scenario is more complicated, please reach out and I can help.